wages are starting to slow. That is the most important thing for the Federal Reserve when we think about how they're looking at inflation. They are very much closely paying attention to wages. So on the one hand, seeing wages start to slow a little bit more is good news for the Fed.
We could see an actual drop in wage inflation, not just a peaking of wage inflation. Nobody's expecting that at the Fed. Everyone thinks that inflation in discretionary goods has peaked, and everyone thinks it will peak soon in wages, but they think wages are sticky and they'll fall really slow. Certainly, wages are more sticky than selling prices. So inflation rates will certainly fall faster in goods than in wages. But if wage inflation is about to hit an air pocket, the Fed could get surprised by that. And it's either telling us the recession is going to be deeper than people are talking about, or it's telling us the Fed might pivot.
Falling knife, still falling. I don't want to touch that. You're saying catch the knife now because it may not look like a knife in, I don't know how long.
Well, I think this next year, maybe the first half of the year is disruptive. I think the second half of 2023 will probably be very strong.
The year 2022 for economies across the globe was marked by resilient growth, high inflation, and hawkish policy. What does the year ahead look like? Where is the market headed? Will inflation slow down? And how can the latest U.S. job report affect the Fed decision? In today's video, Chamath Palihapitiya has shared his outlook of 2023. Stay tuned till the end as he has also shared his advice on which is the best or worst asset for 2023 and how investors should behave in the market right now. While many investors are cautiously positioned for sky-high U.S. inflation to subside following signs of a slowdown in recent months, they also expect monthly price and wage numbers to drive market volatility. To know more, stay tuned till the end of the video. And if you haven't subscribed to my channel yet, be sure to hit that subscribe button for more latest updates on crypto, the market, and economy. Let's dive into the video now.
I will go and pick that inflation, which people expect to fall off a cliff, doesn't fall off a cliff as fast or as meaningfully as people want. And so I will explain inflation as 3 different chapters, and we've seen the first 2 chapters play out. So 2021, chapter 1, was all about energy inflation. And, we all talked about having almost $10 gas at the pump and what does it mean for everybody? And it caused that initial spike in inflation. And then we had it come off, and Sachs called this. He said, we're going to have this sort of double hump. And 2022 was really the story of goods inflation, right? All these prices and all of these things went up because the input costs went up, and we all had to bear the implications of that. But then that started to ebb. And now, if you looked at the tail end of 2022, what I found super interesting was the number of articles I saw about wage inflation, whether that was Biden using an 1800s era law to prevent a railroad strike, the number of states that increased minimum wage, the trend around unionization. So in general, my thought is that the pendulum is swinging very markedly away from capital and towards labor. And as the labor participation rate stays low and continues to go down, and also it's compounded by an unemployment rate that may go up, right? It's going to be harder and harder to get people to do the work you need at the company you have unless you pay them more. And if that gets exaggerated, then inflation will stay where it is. It won't be as muted and it won't fall off a cliff as people want.
You see, the jobs market has emerged as an area of concern as the Federal Reserve works to bring down decades-high inflation in the world's biggest economy. But according to Chamath, there is a high possibility that the third chapter of inflation, wage inflation, is going to continue in 2023. We have also received the latest U.S. job report, according to which the U.S. economy has added jobs at a solid clip in December, pushing the unemployment rate back to a pre-pandemic low of 3.5%, as the labor market remains tight. Non-farm payrolls increased 223,000 in December. You see, the U.S. labor market stayed strong last month and wage gains cooled, boosting hopes the economy will dodge a recession and giving the Federal Reserve room to slow down interest rate hikes. The market may be rejoicing that wage inflation is slowing, but for how long if the lowest unemployment rate in history means there is no one left to employ, said Christopher Rupke, chief economist at FWD Bonds in New York. So, to conclude, we are seeing wage inflation that will keep inflation from going down as much as everyone is wishing for right now.
I think that if we've learned anything from the last 3 years, you have to separate the valuation of a company and how it performs in the stock market with its value in society. So, for example, if you look at Zoom, Zoom's valuation has cratered, but its value in society has probably continued to go up. It's still a massively relied upon tool. The point is that markets do not give you credit for the value in society. They will give you credit when you are about to over-earn, but then they'll pull it all back when they think that you're going to under-earn. So in that lens, I think that tech will have a tough year. I think energy will have a really shit year. I think that there's still a lot of uncertainty in the world and in the markets. And so I'm generally concerned that there's a lot of chop. And so I pick something that's pretty conservative, but I would have a combination of cash and the front end of the yield curve. So T-bills all the way up to 2-year bonds. So you can generate 4.5%, probably by the end of this year, 5% pretty safely owning this stuff while you wait for things to become more certain. And the way that I think about it is that I would rather miss the first 10 or 15% of a rally once we're really done with this stuff than try to overcorrect and try to pick a bottom, just because I think that you could lose a lot of money. So I think the goal for this year is to stay resilient and in the game. And so having a bunch of cash on the sidelines ready to pound it in. Meanwhile, a portion of it collecting 5% is not such a bad thing while you wait for the bottom.
Markets are on edge. The global economy is likely to slow down further. This is an environment where you're going to see a lot of volatility, and choosing where to invest could be $1 million question. According to Chamath, tech and energy is not going to have a very favorable year. Crypto space is also not showing any good news. As Bitcoin's price continues to fall, many investors have seen their holdings significantly devalue, and this crypto winter has wiped over 70,000 Bitcoin millionaires in 2022, as the recent volatility experienced by top cryptocurrency resulted in millionaire holders suffering significant losses. So, in such a situation, what should an investor do? Well, worry not. Let's get into the next clip to see what Chamath thinks of this situation. But before jumping ahead, be sure to like and share.
You have to define what game you want to play before you start playing the game.
Okay.
This is why I think it's kind of nonsensical. For example, I believe that at best, I am an equity investor in technology companies or things that have a technology bias, because I can generally understand them maybe, a few seconds faster than everybody else, which allows me to make a decision a little bit quicker. But if all of a sudden I started investing in debt, you should expect that I'll lose my money because I don't know what I'm doing. And that's not the game where I have any advantage. So I think the most important thing to do is to not try to do all of this crazy stuff, because this is what happens in moments where either things are very, very good or things are very, very bad. People try to create all these stupid rules. And their only rule is there are no rules. So I don't know. I just think it's like, stick to your knitting. If you're a product builder, build products. If you're an early stage investor, just do that. It's hard enough to do any one of those things really, really, really well. But this idea that, you're going to come up with like some mosaic in a system, I think it's just highly suspect. And I think the market returns have showed that everybody that tries has failed except for maybe one or two.
Sachs, any thoughts?
It's just not going to work. What's the point? So I don't know. If you're an early stage investor, make good deals and then give the shares and book the win.
Investors, if already invested, should hold till the recovery. And if you are thinking about whether to invest right now or not, Chamath advises that he is waiting for the bottom. So, when can the market see the bottom? And how low will crypto and everything go? Let me know your thoughts in the comments below. Let's get into the next clip to hear more from Chamath Palihapitiya. According to Chamath, the only rule out there in the market is that there are no rules. You can never know what shoe will drop next. The only thing one can do is read the market to have a better understanding of it. According to him, it's time to hold and wait. In short, the world economy is facing a perfect storm, and markets are not looking so bright in 2023. The question is, How long will it take to weather the storm? And how much higher rates can the Fed impose to bring inflation under control in 2023? Can we see the bottom in the markets this year? If so, how low can Bitcoin drop? And to conclude everything, would you invest in the market right now? Well, let me know your thoughts in the comments section below. For more updates on crypto, the market, and the economy, be sure to subscribe to my channel. And don't forget to give this video a big thumbs up. I'll see you in my next video. Adios, and thanks for watching.